All right, let's dive into something pretty fascinating today. We're looking at two worlds that are starting to collide: the brand new world of cryptocurrency and the very, very old school world of real estate. So what happens when your life savings aren't a digital wallet, but your dream home? Well, that's in the real physical world. Let's figure it out.
This really is the core question for a whole lot of people now. Their wealth is all tied up in digital assets, but the traditional mortgage industry, it really only speaks one language: dollars and cents sitting in a traditional bank account. It's a classic case, isn't it? New money running right up against old rules.
So here is that dilemma, laid out plain and simple. The old way, it just had so much friction. If you wanted to use your crypto to buy a house, you had to sell it. And what happens when you sell? Bam! You could get hit with a massive capital gains tax bill. Or maybe you're forced to sell when the market's down, which is just painful. Or you sell and then miss out on a huge rally. The point is, you lose your position. But look over on the right. There's a potential new way emerging, one that says, hey, maybe you can use your assets without having to get rid of them.
And that brings us to the focus of our explainer today. It's a product from a mortgage lender called Rate, and they've named it RateFi. It's really designed to be exactly what it sounds like: a bridge, connecting the value you have in your digital wallet to the very traditional, very structured mortgage process.
So, what is this thing exactly? Well, first off, it's real. It's an actual mortgage product that's available across the country. And its core idea sounds simple, but believe me, for the mortgage industry, this is a huge shift. It lets you use your verified crypto holdings to help qualify for a home loan, all without selling a single Satoshi. And this quote from Kate Amore over at Rate just nails the whole philosophy behind this. For years, the mortgage industry has basically just pretended this massive new class of assets didn't even exist. This quote just captures that fundamental shift in thinking. It's about treating digital wealth as legitimate, as visible, and as part of a person's complete financial picture. Okay, so that all sounds great in theory, but how does it actually work? In practice, what are the rules of the road here? Let's get into the nitty-gritty of how this goes from an idea to an actual loan application.
The process looks surprisingly familiar. First, you have to verify your crypto assets, prove that you own them, show their history. Second, the lender takes those holdings into account when they're underwriting your loan. But, and this is a really, really big one, look at step 3. You still have to bring cash to the table. Your down payment, your closing costs, that all has to be in good old-fashioned US dollars.
So, the details here are absolutely crucial. Let's break it down. Your crypto can be used to show you have financial reserves, or even help boost your qualifying income. But what it cannot be used for is the down payment or closing costs. That's a hard line. And of course, this all operates within the existing rules. You've got your standard anti-money laundering checks, all that jazz. Oh, and it's not for just any coin. We're mainly talking about stable coins like USDC and USDT, the ones that are pegged to the dollar to keep them from being so volatile.
Now we get to probably the most important technical detail of all. This is the fine print that actually makes this whole product possible in the first place. You need to understand, this is not your standard everyday mortgage. It's what's known in the industry as a non-qualified mortgage, or non-QM for short. So what on earth is that? Well, in simple terms, a non-QM loan is any home loan that doesn't fit into the very specific, very standardized box that government-backed giants like Fannie Mae and Freddie Mac require. And understanding these two worlds is really key. You've got your conforming loans, those are mainstream. They have rigid rules, but they operate at a massive scale. Then you have non-QM loans. These are funded privately, which means the rules can be a lot more flexible. Now, that flexibility is the trade-off. It can sometimes mean different interest rates or terms for the borrower. But it's that very flexibility that makes the non-QM space a kind of testing ground for financial innovation. It's what allows products like RateFi to even exist.
So what does this all mean for the future? Is this just a cool, niche product for a handful of crypto millionaires? Or is this the very first sign of a new normal in how we finance our homes? Let's zoom out and look at the bigger picture.
Think about this number for just a second: 10%. That's the share of Americans who now hold some kind of digital asset. We are way past this being a handful of tech enthusiasts. This is a massive and growing group of potential homebuyers whose wealth is pretty much invisible to the traditional system. So, you see, this isn't really a niche anymore. It's a significant market that lenders are realizing they just can't afford to ignore.
But let's not get too far ahead of ourselves. This quote from Rate's president, Shump Benosian, really grounds the whole idea in reality. He's making it crystal clear that this isn't some wild, disruptive gimmick. The real goal here is to integrate this new asset class into their existing systems, to close loans in a way that's compliant and, eventually, can be done at scale. It's an evolution, not a revolution.
So at the end of the day, the immediate impact of this one product might be pretty limited, but its symbolic significance, well, that's huge. It represents a real modernization of how lenders look at a person's financial health. It's basically an acknowledgement that for a whole new generation of buyers, a balance sheet that's just built on W-2s and bank statements is totally incomplete.
And that leaves us with a fascinating final thought to chew on. We're seeing the first baby steps of integrating digital assets into one of the most traditional purchases a person can ever make. So the question you've got to ask is, will we see a future where your digital wallet is just as important as your W-2 for proving you can buy a home? It's a pretty wild thought, and I guess only time will tell.